for the first edition of the Not Your Average Investor Show, the JWB Rents on the Gut Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC, because he's got these genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, GC.
Hello, everybody. Great to be with you.
Good to be with you too, buddy. And our super duper star community manager back from Mexico is Madison the Magnificent. Welcome, Madison.
Hi, everybody.
And today we were just talking about it. We have a first time watcher of the show as a guest investor. We just got to meet him a little here shortly. He is an IT professional in Southern California working on big stuff for Warner Brothers Studio. He's a well-versed investor in everything from I feel like we haven't even scratched the surface of what you're investing in. It's gonna be a good call. Because I know he's got crypto, I know he's got NFTs, I know he's got real estate, both coasts. He's got some in LA, he's got some in Florida, he's got some in Kansas City. Victor Quevedo, welcome to the show, man.
Thanks for having me.
We're pumped to have you, Victor, and we are pumped to always, this is your first time here, but we've got this community that gets to hang out with us, and we like to welcome our community listening on the podcast, watching on YouTube. What we'd love to do is invite you to hang out with us to get a little closer to us.
Come on, join the party.
Just come on in. Want us fine. NYAIS.com. Register there to join the show. And join us for one of these Tuesday or Thursday calls, or go to our Facebook group. If you look for the Not Your Average Investor Show Facebook group on Facebook, meet everybody that we're about to call out here when we do the roll call. Victor, you ready for the roll call?
Ready.
Let's go. Madison's already welcoming everybody in the chat. Welcome to the Not Your Average Investor Show. We got John Henning, who is often the first one to say something. Good afternoon, John Henning. We got Noel Randari, Noah TBD on a nickname Randari. We got Chris Gonzaga from the Hudson Valley of New York State. Welcome, Chris, to the show. We got Anthony Ditta joining us from Jupiter. He says, greetings, friends. Anthony, I'm pumped to see you coming up here in the super de-duper meetup. We got Leo Faraganan saying saying good morning all the way from the Bay Area, California. We got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Victor, did you know that you could swim with manatees in Homosassa, Florida?
No, I didn't know that.
Magical. All right. We got Miguel Angel Sanudo saying hi, everyone, again. Good to see you all again. Miguel Angel from Granada, Andalusia, Spain, that Greg and I both studied abroad. And we got Vivian Brick is back. Hello, everyone. Viv here from Cali. We got Drew Barnhill, the ringmaster of the Not Your Average Investor Show community.
Good to see you, Drew.
He says, good day, everybody. I'm officially VIP now. Closed on number 5 this morning.
Hey-yo!
Let's go.
Virtual high five to you, Drew.
Love that. Who else we got? Who else is checking in? We got Lee Bishop, of course, the MVP of the Not Your Average Investor Show community. We got Hervé Francois in the house.
Hey,
Happy Thursday, everybody from Jersey. We got Jen Filzen, the fairy godmother of the Not Your Average Investor Show community. Fairy godmother, greetings. She's over here with us. She's in Flagler Beach, hanging out with her grandma.
I didn't know that.
Yeah,
I missed that.
Jen's in town. You're a busy man. That's okay.
Oh,
We got Carolyn Moline and Ken Moline, the patriarch and matriarch of the Not Your Average Investor Show first family. We salute you.
We salute you. It's amazing how your voice slows down whenever we talk about Ken and Carolyn.
Well, you have to have protocol, Greg, when it's the first and second first family. All right. We got Don De Palma. Don. New name? New name?
New name? Is that a new name? I think it's a new name.
It's the dawn of a new era here on the Not Your Average Investor Show. Welcome, Don, from Wenham, Massachusetts. And we got Vera Copeland. Vera is back, and we are very excited to have you here. Hello from Atlanta. And this is officially my favorite roll call we've done in a long time.
You're killing it today, buddy.
I'm feeling it. We got Danette Colvin. Good afternoon. Welcome back, Danette, from Maryland. Danette, did I see that you RSVP'd about coming to the Super Duper meetup? I'm not sure if I saw that. Maybe. I'm not to throw too much
into reality
pressure, but we do have a Super Duper meetup happening June 24th here in Jacksonville. Greg, what's the name of the URL where people can register?
JWBmeetups.com.
Yeah, if you want to come hang out with us in Jacksonville, June 24th, we're going to do a tour downtown. Then we're going to hang out in a brewery. But you know what? That's just one part of the good news I'm here to share, because right now, Madison shares good news.
Hello, everybody. All right. So this is my favorite good news to share, just because it's one of my favorite parts of the company is JWB Cares. So I'm here with a little update on the donations and things we've gotten over the last 3 weeks. So it's not unheard of for us to get new donations from our awesome clients to JWB Cares. However, in the last 3 weeks, we have raised another $600.
No way.
What's super cool about this is 500 of that is from new clients.
No way.
Yes. So it's super cool that not only our current clients believe in what we're doing and the movement, but our new clients are contributing a lot. So
It's amazing, Madison. Can you share with people how they actually get to contribute and how we make it easy for them?
yeah, so you can go to jwbcares.org, or if you put a house under contract, there is Brandon and Stu are awesome about kind of walking you through this, but there is a part of your contract when you put a house under contract that you can opt in to donate $100 a door, 200, however you want to do. So it just gets added on to those closing costs at the end.
It's amazing.
Love that. I love that she called it a movement.
I
movement.
love Madison shares good news. It's impossible not to start the day off by smiling when you hear Madison shares good news.
It's my favorite segment of the show. All right, now on to my second favorite segment of the show, to the star of the show today, Victor Quevedo, joining us from LA. I think he said in Pasadena, California, home of the Rose Bowl. Victor, tell us a little bit about your investments. We kind of teased it a little bit. Tell us what kind of stuff that you're building wealth in.
So I have several rental properties. I have 2 in Jacksonville and supposed to be closing the 3rd one next week.
Congratulations.
Yeah, thanks. So I got introduced through you guys through Fortune Builders. That's where I think a lot of people, especially me, I know, was hesitant to invest out of state because I wasn't sure how I could manage it or how, I could find it and like to see if it's a good deal or so then, through Fortune Builders, they introduced me to you guys. And then that's how I decided to get involved. And yeah, then I ended up getting another one in Kansas City. So you have to think about it differently. I think it's like more of like when you buy a stock, right? You don't know all the details about the company and you're just buying it, but I guess you can apply that to real estate as well. As long as you have a good manager, I think that's the most important thing.
Absolutely. Sometimes we overcomplicate this decision. We hold the decision to invest in a rental property to a different standard than we hold the same decision to invest in stocks. And the vast majority of people just basically see one of 10 stock options that they see and they just click a button. They're like, oh yeah, cool. I'm cool with doing it that way. But then they're like, well, listen, I have to go and kick the tires on this rental property before I can invest. Like, how does that make sense? Right?
No. Yeah.
Yeah. I wonder if people buying stock in Texaco are like, I'm gonna go examine this gasoline over here.
Yeah.
I'm gonna go pump a little bit of this before I buy it.
Let me go and interview the suppliers for Texaco before I'm going to go and make a decision to invest my money in them. It's just different.
That's funny, man. All right, Victor. Victor, I'm gonna apologize ahead of time. I have a friend in Miami called Jaime Quevedo. So like every time I go to say your name, I'm like, huh? Victor.
Well, it's part and parcel. That's how we show love on the show, is that we have Pablo just butcher names.
It's
so
true.
consider yourself officially a part of the crew.
I'm the butcherer of names on the shows. One of my many roles. All right, Jaime. Victor. I just chased myself. All right, Victor. We're going to get into your story. We're going to get into your investing journey. But for right now, we're going to pop up the property of the week. And
Wait.
And we're going to go through it. Let us know what you think. You're going to get a chance to be the guest investor and let us know what you think of this thing as if you were analyzing it for your own portfolio. So we're magically whisking away right now to 3038 Rayford Street, Jacksonville, Florida, 32205. It's got a purchase price of $275,000. It is a 4-bedroom, 2.5 bathroom, 1-car garage, leased at $1698. And it's got a positive cash flow of $69 per month and an ROI of 12.16%. Victor, before I ask you what you like about it, GC, what do you like about this property?
Now I know you love me too. This is amazing. You're just spreading the love today.
I do. It's true. I love you.
Well, I'll tell you what I love about this property, right? Right now in this investing space, it is so tough to find inventory for everyday people who want to invest in real estate. You've probably heard this, you've read the headlines, maybe you've tried to actually buy properties and been, not impressed with how many obstacles you have to jump through. Well, here, what I love about this property, number one, it's available. So let's just get that out there before you ask me later. This is available, and that's an amazing opportunity right now in a place where they're not usually available in the real estate market. But not only is this available, it's rented. It is already rented day one. See, the way that most people invest right now is you have this idea that you want to buy a rental property because you know it's a great investment and the fundamentals of it are strong compared to your other options right now in the stock market, which are not strong. And then you're like, okay, cool. Let me put a lot of hard work in to buying that property for maybe 6 months or 9 months. And then you finally get it under contract. And then you have to wait as the house is built, or you have to wait as the house is renovated, and then it gets renovated. Maybe that takes 2 months. And then you have to wait another 2 months for that home to get actually filled with a resident and for them to actually move in. You avoid all of that here. This home is built. It is already rented. It has been rented for a long time. And that means positive cash flow for you from day one. And you have the ability to buy it today and lock in your interest rate today and lock in your price today before it goes up. And Victor, you and I were talking before the show a little bit about your experience as far as prices going up. So, you know, maybe you can chime in there in a few minutes as far as how valuable that is. But the last thing that I wanted to give a little bit of extra information on why I love this property, just looking at the history here with the resident that we have. This is a resident that clearly loves this home, and I'll tell you why. They have been living in this home since 2017. And this resident has chosen already to renew the lease multiple times. The most recent renewal was just last month in May. And not only did they choose to renew, but rent rates have gone up significantly. When a resident renews with JWB, they are brought up to the market rent. And so this resident made the decision to renew again, and their rent went up from $1,249 a month to $1,662 a month. Okay, that's a $413 increase per month, 11.4%. And they signed not just a 1-year renewal, a 2-year renewal. So they love this house. We want residents that, of course, love the homes that we're in, because that means there's a greater chance of them staying longer. And when you have happy residents that stay longer, you win as a rental property investor. So I like this one.
A lot to love there. Victor, when you, I guess, first of all, this whole idea of value of a home being available right now, right? Like you're about to close on a home that you had purchased pre-construction. It took a minute, right? Like when did you, this home that you were about to close on, when did you first sign up for it?
So I went over in October and to look at my other properties, and then they showed me this property that it was just land, really. It hasn't even started construction. And so I put a deposit on it, and so yeah, since October. So it's been what, 9 months.
Yeah, and that's real,
Yeah.
right? I mean, that is really the space right now. You know, we internally made a switch where we just stopped allowing clients to put homes under contract before they were built. And the reason there is because there is so much variability now in the construction world that it just doesn't make sense for us to do that. And it leads to a poor client experience. Victor, let's talk about some of the things that probably haven't gone perfectly. Has the home been delayed as far as the build with you?
Yeah, it was originally supposed to be done in April. So yeah, it's got delayed a couple months.
It's been delayed, and we don't like that, right? And that's unfortunately something that's out of our control right now. The way to control it was to change to now only bringing properties to our clients that they can put under contract today, like this one on Rayford, where we don't have that variability of timeline with the build being completed or a renovation being completed, right? This is something that is much more tangible and can take action on, which we love.
Cool. So Victor, tell me, man, so you've done this now 3 times, right? Since you're going to be a 3rd-time investor, you've done this in other properties where people put a pro forma in front of you like this, right? One of these property analysis.
Yes.
What's the first place that you start to look here?
So I guess first it depends on your budget, right? Like, what are you looking for? How much you want to spend? So I would look at that, right? If let's say my budget's 250 to 300, then now I go forward. And then I'm going to look at the layout. I'm also going to look at the location of the property. So I would, Google map it, check out the street, check out the area, see what I like about it. And then, yeah, when it was built, I'm going to look at, yeah, the square footage, and then I'm going to look at the, you know, the cash flow.
Got it. So are you looking, are you looking specifically at cash flow first, or are you looking at this ROI number?
No, yeah, I'm looking at both.
Yeah. How do you kind of like consider balance the two of what you're looking for in these?
So yeah, I guess it just depends on like what, if it's more of, if I'm thinking about long-term and I'm thinking about appreciation, then cash flow is not, a high cash flow is not very important. And otherwise I want a higher cash flow, but then I know maybe you have to sacrifice in other areas, right? Maybe the area or, you know, different things. If it may be an older home to get a higher cash flow. So it's a balance, and you know, you have to look at different options in order to figure out what you want to do, like all available properties, I think.
Yeah, makes a lot of sense. JC?
Yeah, no, I love to kind of understand from your perspective as somebody who has invested in different types of properties, renovations, new constructions, also in different markets. You know, do you have the opinion of an overall portfolio, and you might choose one market because that is your growth market? Do you have another market where you say, well, maybe that's my cash flow monster market? And is that how you've made some of those decisions? Or what could you share with others who might be in a similar position as to what's worked for you?
Yeah, I think you have to look at what's available. Well, you know, first you can look at like the best cities in order to do rental properties. And, you know, Jacksonville is in the top 10, I think, as well as there's a few other ones. So then once you figure out the city, then you have to go into more detail and figure out, okay, the area. And then, you know, Jacksonville is, it's known for its cash flow and appreciation. You know, in Kansas City, it's supposed to be more cash flow, but it's actually been appreciating a lot as well. I think that's been pretty much the case all over the place because the inflation. But yeah, like I'm looking at Kansas City, Indianapolis, Jacksonville, St. Louis, Memphis, a lot of those cities where the properties are not too expensive and they have good rentals, a lot of rental people renting, a lot of jobs.
So what I'm hearing from you is the market's really important, right?
Yeah.
And we have a real life example of how a decision you made last October to buy this property in Jacksonville. Could we get a little bit more specific on, you know, I'm sure you had options to invest in those other markets. Let's go back to October, and you were looking at the evaluation that you had, and you said, all right, this is the right one for me versus adding another one in Kansas City or Indianapolis. What was it for you that jumped out right there?
So I had actually never seen the properties. So I initially purchased the properties about 5 years ago. And I've been to Jacksonville like 10 years ago, but I'd never seen those properties that I bought. So I wanted to go and then I took my other friend who's interested in purchasing property. And we drove around my properties and we looked at other properties that were available. And I liked the area for this property, which was pretty close to one of the other properties. And I wanted new construction because the prices were pretty similar anyways. And then the cash flow was good. I knew appreciation was going to be good. So then that's the reason I chose this one. And, you know, based on the inventory at the time.
Makes a lot of sense. And another reason why we should have anybody who's interested coming on out to that Jacksonville tour on June 24th, that's true. Right? That's true. It's amazing how when you don't have to come to a market to be able to buy a rental property, but if you have a chance to come out there and see a market like this, clearly it helps you have more confidence to go ahead and invest some of your hard-earned dollars in that marketplace. So come on out June 24th.
Yeah, coming out June 24th. Victor, you were also telling us something. You were just hitting on this whole like appreciation play. And we just talked about kind of the downside of having locked up your property 8 months ago, but there's an upside that you were kind of sharing with us a second ago, right?
Yeah. Well, I wasn't in a hurry to buy, right? I just, the main thing was to look at what was available, see what the area that I wanted. And I wanted to buy another property, but I wasn't in a hurry. So that's the reason I was fine, you know, locking it up for so long. And then I also knew that, you know, the rates were going to go up and all the costs are going up, the building costs. Remember we had that lumber issue.
Oh yeah.
So I was fine locking it up and I knew that most likely the property would go up in value. So I put in a contract for 185 and I just got appraised last week for 200.
Congratulations. That's not normal.
No, I know it's not normal.
But we are super happy for you. I mean, I
Yeah.
think, you know, when you make decisions, right? I mean, we talked openly about how prices are going up. I didn't know that build costs were going to take this long, but you know, it was easy to see that locking in a purchase price was a good idea, you know, just like it's a good idea right now. Because as we look at the fundamentals of the Jacksonville marketplace, months of inventory, which are the same metric we were looking at back in the day, last October, when we were saying you should put them under contract now because they're going to go up in price. Months of inventory today is lower than what it was last October, which means that it's a stronger indication in the short run, home prices are going to be going up.
Yeah, that's pretty sweet to what's the math on that? 185 to 200,000, 15,000 bucks.
Over 185,000 divided by 2 because it's been 6 months or 9
Carry
months.
the
I don't know.
niner.
So somebody figure out how much that's appreciated. It's probably like 20%.
I'm sure we got somebody in the community that's going to be able to do. What were you going to say, bud?
I wanted to play a little devil's advocate with you, Victor. All right. And I know you're super excited about the property and you know I'm supportive, but let me try to unconvince you to not do this property just for the sake of the show and for everybody. All right.
Yeah.
So when you put the property under contract in October of last year, right, we had the best estimate for what interest rates were going to be at that time. And your interest rate on your evaluation, I am confident, was a lot lower than the interest rate that you locked in.
Oh yeah.
It's not what we want, right? But if we're talking about that, right, I'm not sure what your rate is today, but it's a lot higher, right? Why would you decide to still close on that property and be so excited about it, even though your interest rate is a lot higher than what you expected in October of last year?
Well, first of all, the interest rates are going to keep going up.
Amen.
So I locked in 5.25. I probably could have got like maybe at least a point less. So let's just say 4.25.
Yeah.
But I guarantee you in another month, it's going to be at least a half point higher because
Why
they're
do you
going to
think
raise
that?
the rate next
Yeah,
week.
you hear what the Fed's saying, right? They have telegraphed they're going to be raising rates.
Yeah.
They're going to be doing it twice as aggressive as they normally do. They normally bump short-term interest rates a 1/4 point. They're going to bump them a 1/2 point. And they're going to do what, 5 or 6? The number keeps going up every time I read an article about how many more rate hikes we're going to see this year, right?
Yeah. And then the thing is, it doesn't really matter too much because the property is not that expensive. And, you know, with the down payment, the amount financed is not that much. So even a % increase is not a lot.
Yeah.
I mean, obviously it reduces your cash flow, but when you think about it overall, it's still a good deal.
Still a great deal. And oh, by the way, you're starting out with some built-in equity, which is
Yeah.
not normal for buying a turnkey rental property. So it's, you know, if I had a little bit of a rate bump on for what I expected, but
Yeah.
you put 15 grand in equity in my pocket day one. I mean, I didn't include that in your client journey, which we're going to go over here in just a second. But I mean, that's a really wonderful way to start out. And you'd be giving that up if you didn't close.
Yeah.
You know?
Oh yeah.
Victor, for you, you know, so you've talked a lot about, first of all, Vivian Brake just said her and her sister just put their second JWB home under contract this week.
All right. Congratulations.
Yeah.
I feel like high five.
High five.
Virtual high five.
I love it. And Drew put in a eye-popping stat here in the chat. He said that he saw an article the other day which talked about rent rates in different cities. Some places like Kansas City, Missouri have higher cash flow properties, but their rents actually declined 0.1% in the last year, whereas Jacksonville rents increased 30%. So cash flow is not everything, but only one component, right? So, Victor, you've got a property. You said you have one in Kansas City, right?
Yes.
How has when did you buy that one, and when did you buy your first JWB property?
So I bought that one after. So I bought it about 3 years ago.
Okay. Have you had a turn? Have you experienced any kind of like moment of like renegotiating rent on either one of your properties?
So the way that the Kansas City market works is they only do a year lease, but it auto renews unless they opt out.
Mm-hmm.
So I've had the same renter in there. They're happy. The rent, I think it's increased slightly, but it doesn't, the rent doesn't increase very much.
That was my next question. There's different ways to do, call it long-term leases or 1-year leases and auto renewals. I was in order to do an auto renewal, I'm just speaking off the cuff here, I would think that you would have to preset what your expected rent rate was like 3.5 years ago when you bought that property, which I would imagine is probably more with historical averages of, call it 3%, maybe 3.5%. So is that what you've experienced? People have stayed in the home, but you've gotten, call it, 3 or 3.5% rent increases, which, rents have increased a lot more than that over the last 3 years. So we left a little bit of money on the table there, but you have a long-term resident. Is that pretty accurate?
Yeah.
Okay, cool. Good to understand.
That's interesting. What about your homes in LA? So where I was going to kind of go with this is I wanted to talk about that stat and get that comparison, but you've talked a lot about appreciation in these last 5 minutes, right? I was just kind of wondering what is your long-term outlook? Like, what is your outlook for these properties? Where do they sit in your head as far as what your portfolio is comprised of and what they do for you within that segment of the portfolio?
So those are, long-term investments that'll be there for retirement, right? So eventually they'll be paid off, and obviously the plan is to keep accumulating, but and then do what I think you guys had mentioned. Once you pay off a property, then take all that cash flow and just start paying down other properties and just accumulating like that. So that's the plan.
Cool. So you got like an outlook for this is like similar to like a 401k or an IRA, where it's like you're not expecting to tap into this during your career. You're trying to gain this equity so that when it's retirement time, all that cash flow is just coming into your pocket. Is that kind of how you're thinking about it?
Exactly.
I love putting this on the same level playing field of how we make decisions with 401ks or stocks, right? Sometimes we say, geez, in real estate, well, geez, you have to hold on for 10 or 20 years in order to see the full benefits of this. And it sounds like it's a negative thing in the real estate world. But, what do we do with the stock market, especially in our 401k? First of all, we just tap a button. We don't even look at a prospectus, and we just put all of our wealth there. And then we're like, hey, it's totally cool. I'm not going to touch it for 60 years.
Yeah.
Like, how is that okay there? But then we're going to say, well, this is, what real estate doesn't pay me quick enough.
I'm glad we're having this conversation, man, because that hit home for me yesterday when I was, we're closing in on our third property, like Victor, and I cashed out my IRA in order to go into this asset class, in order to lock in the gains that I've had. And, my belief that the 10% penalty is going to have me way ahead of the 30 to 40% haircut I think the market is about to take.
Love that.
And it's not stuff that I'm going to, touch for 40 years. I was telling my wife my wife and I were talking about the property and how we're closing, and because I got like a final check from the IRA that was like 26 cents to finally close it out. I was like, oh, this was like the last little bit of money in that IRA account.
Gotcha.
She's like, so we're completely out. Like, you cashed it out. I thought you were only going to cash out a little bit to do this. And my head went to the conversation with George Grombacher. On Tuesday, we had a behavioral finance expert, Victor, that talked about like our relationship with money. And my head went straight to that. And instead of just being like, no, it doesn't matter, blah, 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 I was like, oh, okay, tell me more about how you feel.
Way to go, dude.
And she was like, well, I just, that was there, and that was going to be like a safety thing. And I'm like, do you ever think that we were going to need that money at any point? Because she was just like, well, now we're locked up in this property. I'm like, did you ever think that the 401, this IRA money, that we were going to tap into that? She's like, no, not really. And I was like, it's the same with this property,
yeah,
right? Like it's the same exact mechanism. We were not going to tap into the equity and the appreciation and all the good things that are happening up until much, much later in our life. But guess what? Within the next 10 years, we're going to tap into this cash flow, and maybe even be able to like borrow on the equity to get more cash flow and things of that sort. So it's just really valuable to me.
It's flipping the paradigm. It's a paradigm shift, right? We have felt like safety and security for it just being in this 401k, but in reality, it didn't affect our daily lives, right? Mm-hmm. And in reality, it's a lot more variable there, as we're seeing now with what the markets have done since the beginning of the year. And real estate can accomplish the goals and overcome the concerns that we all have if we look at it and compare it apples to apples to what the stock market does for us and doesn't do,
Yeah.
Victor, in your LA, let's talk about LA specifically, right? Like we talk a lot about Kansas City and other cash flow markets. In your LA homes, what do the numbers look like there, and what's the play there?
Well, LA has the appreciation here is crazy, right? One of my properties, it's doubled in value. I got it. I bought it a long time ago, like maybe 15 years ago for 280. Now my neighbor just sold hers for 620.
Nice.
It's crazy.
And then with my other partners, so I have two other friends that we bought several properties with.
Mhm.
Those have appreciated crazy. We have 6 of them, and some have doubled, tripled in value. It's the market here is just crazy.
Yeah.
It just goes up so fast and
Mhm.
so much. It's like, that's the reason it's too hard to find a good rental unless you have a lot of money for down payment. You're going to have a negative cash flow, or you're going to buy something that you're going to need to fix up a lot.
So is that are your homes that you bought in LA, you had bought them early when there was cash flow, or did you just have a lot of down payment to put down, or are you negative in cash flow?
No. Yeah, we got those a long time ago, 10, 15 years ago, when the property prices were really low. And then, one we bought, I think 3 years ago, but that one we fixed it up and then we're renting it out. We were going to flip it,
Mhm.
but we ended up getting under contract like the same day we got an offer. So we just rented it out.
You picked a good 3 years to hold on to that property.
Yeah.
Way to go. Good to have backup options.
Yeah. And then, like I was mentioning before, I've done some flips here as well, but that's, the prices here are so expensive that it locks up a lot of cash and it's very risky. And you really need to have a lot of expertise in that because it's so risky. So I'm not really doing that right now. Like I said, I'm more focusing on other investments like crypto and stocks.
Take it away, brother.
I mean, I don't know if you wanted to go into crypto. I think that's a whole nother rabbit hole we can go, but I was doing the math. You said 15 years ago. Did you buy this property in 2007?
2008.
So tell me about that. Well, like, had the market crashed? Did you buy in and then it crashed? Like what
No.
what happened there?
It already crashed.
Okay.
So I bought this as a short sale, and the guy that had bought it, he paid like 420,
Mhm.
and I got it for 280.
Yeah. And this is showing that Victor is a buy and hold investor. He's also an active, call it fix and flip investor, right? As a traditional kind of turnkey buyer or buy and hold investor, you're typically not going to want to put the work into buying undervalued real estate. In a short sale, for those who aren't aware, is an opportunity. It used to be a much bigger opportunity because we used to have a lot more foreclosures, especially in 2008 was the start of the foreclosure crisis. You could put the work in as an active investor and buy a short sale and get a really good undervalued deal. And so that's what Victor did back then.
Yeah, and then actually a lot of the other properties were foreclosures as well.
Yeah.
Makes sense. All right. I was wondering how, at first I was like, man, Victor looks so young. He was investing 15 years ago. I was like, wait a minute, 15 years ago was the Great Recession.
Yeah. Yep.
All right. We got a Q&A here from Miguel Angel Sanudo. Welcome, Miguel Angel. Good to have you, man. He's putting in here, in this inflation situation, is it good to have a long contract, or is it better to renew more often, catching up prices? I would assume he's talking about rents. Victor, what's your take on that?
Yeah, I think you could have a long-term rental, just have built in the contract, that you're going to have an increase. Obviously you won't get the same rent as you would if you had a yearly renewal, but then you have less of a headache, right? You don't have to worry about turnover as much. So
Yeah, I think the ideal solution is to sign long-term leases with substantial rent increases along the way, and then bringing people up to market rent if there's ever a discrepancy, and being really good at renewing people. Like an auto renewal not forces people, but they have to opt out, right? If you can just have an open conversation and renew a really high percentage of people, knowing that they're going to be brought up to the market rent, that's more ideal. I'll kind of compare the provider that is in Kansas City to JWB's approach, right? So try to compare apples to apples here. in 2017, and Victor, tell me if I'm a little bit off here because I'm shooting from the hip here. But in 2017, let's say that you put the home it was leased out. There was a 1-year lease that was signed, and then it probably had an auto renewal every year with an automatic rent increase of, let's just say, 3%. Is that pretty much how it was structured?
Yeah.
Yeah. And that resident has stayed every year and still is. And so they've been in there for 5 years. Well, it's not surprising to me that resident's going to choose to stay there and renew, because they are they are renting way under market rent at this point. I don't know the exact rent year over year in Kansas City, but in Jacksonville, year over year, just for single family homes, 10.5% year over year is what we gained last year, and then the year before was significant as well. I don't know, call it 7 to 8%. So if we had done the same thing for our Jacksonville portfolio, we would have lost, 5% on the rents that we could have gotten 2 years ago, 7% on the rents that we could have gotten last year. And you start to total that up, and that's significant cash flow that you're missing out on. I won't say that automatic renewals are a terrible thing, but what is ideal is if you can sign long-term leases. In those long-term leases, there are rent increases along the way, and then high renewal rates get you up to market value for rents. Our renewal increases for our 2 and our 3 year leases, you're averaging between a 4 to 6% increase on rents that's baked in when the lease is signed. So that's not to 10%, that we got last year, but the next time they renew 2 years in, right, they are brought right back up to market rent. So it's a best of all world scenario. It works because we re-sign over 70% of our residents. If we didn't re-sign over 70% of our residents just by asking, do you want to renew? Like, this model wouldn't work as well because you would have high turnover costs and all that good stuff. So I think it really comes down to if your property management team can do that, that is a better way to go about it, would be my opinion.
There you go, Miguel Angel. Great question, man. We got one more question, and then we're gonna dip into Victor's story here. But we got a longtime fan from France dialing in here. Anonymous attendee asks, if prices are expected to dip in the next 12 to 24 months, why buy now? This is assuming that it'll be a long-term buy and hold. Victor, what do you think of the likelihood of prices dipping versus buying now and stuff like that?
I'd say, the prices will probably come down a little bit as interest rates go up because people can afford less. But if it's a long term, then I'm not worried about it because it's rented out anyways, and it's not something that I'm going to flip. If it's something that I was going to flip, then that would definitely be something to look at because the next person coming in, right, he's going to have to pay a higher rate. He's not going to be able to afford the same amount.
I like what you're saying there. There's a difference between length of time is really important, right? And what is your exit strategy? If it's a 1-year exit strategy, I'd be paying a lot more attention to what I think prices are going to do in 12 to 24 months. I'm not convinced that home prices are going to dip in 12 to 24 months.
In Jacksonville,
right? Yeah. What I'm really confident in is that home prices today are lower than they're going to be come the end of 2022. And the reason that I feel that way is because of supply, months of inventory, and supply right now is incredibly low. We're at about 1.3 months of inventory. Historically, you should be about 6 to 7 to have an equilibrium market. So right now, if we're talking about, let's just go to this place that we think home prices are going to dip in 12 to 24 months, just for the sake of this conversation. If you have the opportunity to buy now, and the fundamentals show that there's probably going to be price increases from here until that point, well, you'd be missing out on the price increases that you had from now until that point. Then let's just say that they dip. It is really rare for home prices to dip, right? They haven't dipped many times over the course of history in Jacksonville's real estate market and across the country. But let's just say that they do. The type of dip that we're talking about is usually very small. And when I say it's small, I'm comparing that to dips in other asset classes where your money may be. Like we need to think a little bit beyond just like, is the market going to go up or down in real estate here? And think about this holistically. And where else would I put my money? And I don't feel very good about what the stock market's going to do in the next 12 to 24 months.
Yep.
Right. So you need to take that into account. But let's just say that you still feel really good about the stock market and you think that real estate is going to dip in 12 to 24 months, which is the opposite of how I feel. Right. Well, Victor hit the point on the head. It is really hard to lose in rental property investing if you buy and hold for a full market cycle. And I know how this feels because as a 23-year-old kid who didn't really know much about any of this stuff, my business partners and I invested in 40 rental properties in 2007 at the absolute height of the market, which we then saw values drop 35% over the next 3 to 4 years. And I still own those properties today. I've held on to them, 15, 16 years now. And if you look at the average growth rate of those properties, right, they still appreciated around 3.5% per year on average, really close to what the average historical appreciation rate is in Jacksonville, because that's how supply and demand works for a critical asset and a critical need like real estate. Things come back to the norm, supply and demand work in your favor, and properties tend to appreciate at a rate that's similar to inflation. So I hope I kind of like went through all aspects of that journey right there. The other thing is like, do you want to make decisions today on what could possibly happen in a year from now? Like, I would rather just make decisions today on where do I see the fundamentals of this asset class versus where do I see the fundamentals of that other place I could put my money. And real estate looks a whole lot better than the stock market does today.
Yeah. And I think, in Jacksonville, I would agree with you about the prices, but over here in LA, the prices have gone up a lot. So they're going to come down because it's not affordable, right?
You do have much more affordability issues in other parts of the country. Probably LA is the least affordable or close to it.
And a net migration that's pointing negative first time ever, while we're at like historic growth rates over here.
Yeah.
Right.
Like there is other data points here that point to that. The other thing that I've heard that is an interesting point here is the idea that, Victor was able to capitalize on these like bank-owned properties. People working at banks were still working at that bank when Victor did these deals, right? So they've learned that, they've learned what to do during a crash is not to just to liquidate an inventory.
Right.
They've figured out how to like make money themselves on this stuff. So the amount of availability and all these deals that happened in this like once in a lifetime event during the Great Recession, it's going to be very different in this next recession.
It's hard to think it's going to be like this recession, even if real estate is dragged down. It's hard to believe that the crash is going to be nearly as strong in real estate. Right? Because of the banks that now have entire departments to deal with assets that are behind on their payments, so they don't have to liquidate for such a loss. The influx of Wall Street money that is searching for these assets as well. You have in a lot more demand just built in than you had back in the day. So you would think even in a worst case scenario, the landing here would be a lot softer than what we experienced in 2008. So yeah.
Cool. Well, we got kind of derailed here with an awesome question by Anonymous, but Victor, this is the moment where we go into your story, and Victor Quevedo, this is your life.
Victor, before we start here, I wanted to get a little insight into why you're investing. What's motivating you beyond just the retirement answer? Talk to me a little bit about what you're passionate about. What do you see like when you are going to retire because of these investments? What are you going to be doing with your time? What moves you?
I like traveling, like visiting new places. I've been to like 40 different countries.
Really?
Yeah. So
What's your favorite country to travel to?
I really like Colombia. Colombia is really nice.
I've
been there like 6 times.
I want to go to Colombia. That's on my list. Well, that's wonderful. It's really great to understand kind of why you're doing this, because just from like call it an outside perspective, you're a super successful IT professional in California, and you made this decision to invest in rental properties, which doesn't sound like you've done a whole lot of work prior to your relationship with Fortune Builders and with JWB in a couple different places. Doesn't sound like you were like a real estate guy growing up. Did I read that correctly?
Yeah.
Okay.
Yeah, that's right.
So you've made this decision to go and invest in something that people probably called you crazy to invest in at some point, and you continue to reinvest in it because you see the value in it. And then you also have brought your friends and your family, and you've referred, I think, is it 3 friends you've referred to JWB?
Yeah, 3 people.
It's incredible. It's incredible. I know when you make such a decision to do that, that is one that takes a lot of courage. It takes a lot of due diligence. You make that, and then you continue to do this. And people don't make those types of kind of different decisions with their money unless there's a big payoff. So we got to get you traveling to all the countries in the world. We're at 40. Maybe we should keep a ticker here for you. See how many countries you get to. Well, wonderful. It's good to know that. We've got these 2 properties. These are the actual properties that Victor purchased. Does this look familiar, my friend?
Yeah.
All right. We've got that one on Mall Street. And that one looks to be new construction. Was it brand new construction? It was, right?
Yeah, it was.
Okay,
Brand new.
wonderful. Look at that purchase price that you purchased that for just 5 short years ago,
Yeah.
$145,000. They ain't making any new construction properties these day and ages in Jacksonville to be able to purchase for $145,000. So congratulations on that one there, Victor.
And then I just refinanced last year.
Did you?
Yeah.
Walk us through that. Why did you make that decision?
Oh, because the rates were so low.
Yeah. So what rate did you get?
I think it was 4%.
4%. Amazing.
Yeah.
You lock that money up for 30 years, assuming you keep that loan out there, 4%. Amazing. And then did you get to pull any cash out?
No, I didn't pull any cash out. I just wanted to take advantage of the lower rate.
Gotcha. Well, you have a tremendous amount of equity in those properties, which we're going to get to in just a second. And then your next home on Madison, the Magnificent Avenue there. How about that?
Sounds like a magnificent street to live in.
And this was a renovation. So talk to folks about why you decided to choose a renovation. I heard you talk about how much you love new construction, but you bought a reno. What was going on there?
So I wanted to get a mix.
Mhm.
So yeah, I wanted to get a new construction, and then the renovation was a little bit cheaper and a little bit bigger property, the size of the property as well as the land.
Mhm.
So I just wanted to have a combination of
Wonderful.
different types of properties.
Did you refinance that one as well?
No, I was going to, but yeah, I didn't do that one.
Yeah. It's huge opportunities. You have built up equity there that if you're thinking about how to get to that plan, the plan to be able to travel like you're talking about, and you wanted to make other investments to get you there, whether that is crypto, it sounds like, or NFTs or wherever you are, obviously real estate's an option, or private lending is an option as well. You're sitting on a lot of equity that you could borrow and then make a lot more money on what you are on the asset versus what you're borrowing for. So keep that in mind for future planning for yourself. Okay.
Okay.
So we've got those 2 properties here. As we always do, we want to show the good, the bad, and the ugly here of a real life client journey. So I pull the highest lifetime return. When you have 2 properties, it makes this pretty simple. This is the actual lifetime return on investment. Just what's hit your bank account so far as you're owning these properties. Does not include home price appreciation. And your home on Mall Street has performed incredibly well here. Just over 13% annualized lifetime returns. And that's just including things like cash flow, tax savings, and principal pay down, not including the biggest profit center, which we know is going to be home price appreciation here in a second. Did you know this?
No, I didn't really look at that.
That's awesome. That's awesome. Well, we produce these, this client ROI report for you every single month. Don't feel bad that you haven't been paying attention to it. Some clients love it. Some clients don't log in and don't see it. I always encourage folks to log in every once in a while, because it's going to help you make better decisions where to put your money on that next asset. And you've got one that's performed really, really well here. I will say you shouldn't fall too much in love with it, because as you have a property that's performed at, 18%, 17%, 28% the last few years, here, guess what? This is cyclical, right? Yeah. Eventually that resident is going to move out. Eventually you're going to have a property turn. Eventually things will return to the norm. And that's a segue for your next property, which hasn't performed as well.
Yeah.
So this is the one on Madison, the Magnificent Avenue. And we've had some growing pains with this one. Victor, yeah. I don't know exactly what growing pains we've had. So I would love to hear from your perspective. Could you share with folks? I mean, we've had some negative return years here, right? To me, that probably speaks of vacancies or property turns or other things. Could you talk about maybe some of the pain points that you've had with the portfolio?
Yeah, it's I would say, I think 2 or 3 people that we had to evict. And it's been over, obviously, I think in 2019, and then as well as last 2021. Actually, I think it was 2020, really.
Mm-hmm.
That's the other person was unable to make the payments. I guess they lost their job,
We had back-to-back
Which is-
evictions, it sounds like.
yeah.
That's not normal, right?
And then, I was wondering why. I was thinking maybe it wasn't a good area, but then when I went there, it was nice. I like the area. The property looks good.
Well, I
So-
think that's a natural question. When you have one that performs well and it's in one area, and you have one that performs not so well, below expectations, like this one on Madison, I think it's a really worthwhile question to ask. And I think that's reason why you invest with a partner like JWB, right? We put you in those neighborhoods because we have the breadth of knowledge and experience that goes beyond just like, does this property work here or does this property work here? And those neighborhoods there on Madison and on Mall Street, very similar demographics. Is that what you sort of experienced when you came down and saw them?
Yeah, they look really nice. Good areas. They had nice homes around it. It was just, I guess, bad luck.
Well, this is how rental property investing works. It's not perfect, right? And if
Yeah.
you owned 5 or 10, you'd have 2 or 3 more examples of some shining stars for 5 years, and then some ones that aren't performing for that 5-year span. My guess is that what you're going to see the next 5 years in Madison is probably going to be a lot better than what you previously saw. And my guess for what you saw on Mall Street is probably going to be worse than what you've experienced
Yeah,
for the last 5 years on the cash flow basis, because this is real life. We're working with families, and sometimes people make poor decisions and don't live up to their end of the bargain when they're renting homes from us, right? And we try very hard not to have that happen, but more than trying hard not to have it happen, I want you coming in with eyes wide open, like it can happen, and I think that's what we have here. The good thing is that we've righted the ship, and 2022 seems to be going very well with a 12.5% return annualized, through 6 months. So seems like we're doing some good things. Is that your impression so far this year for Madison?
Yeah.
Cool.
Yeah. So far, so good.
I would expect that to continue. All right. So now we're going to get to the really fun part. So Victor, what I just showed you there, and to everybody who's tuning in here, what I just showed you was a very small glimpse of the big picture of how Victor's money is working for him. Now we're taking a look at all 5 profit centers. From 2017 to current, we're going to look at net rental income, tax savings, principal pay down, home price appreciation, and we're even going to talk a little bit about inflation hedging, because those are the 5 profit centers. Those are the reason that Victor decided to invest. It wasn't just cash flow. It just wasn't tax savings. It wasn't one of the other. But let's take a look at net rental income right off the bat here. Victor, your entire portfolio over these 5 years, we're negative on cash flow, brother. Why are you so happy about this investment? Why are you smiling over there?
Yeah, because appreciation and tax savings. And like I said, I'm not looking for any rental income.
Yeah. We're not happy that you've had negative cash flow, and I don't mean to make light of it. But when we look in totality as far as how hard Victor's money is working for him, we're doing really good. We're really happy with the performance that we have as a manager of the asset for Victor, putting him in the neighborhoods that we did, managing them the way that we have. Of course, we expected there to be growth. I won't say we expected this much growth, but we're certainly not surprised. So we've got negative $8,823 in net rental income here. Not what I expected for Victor, but you're going to see how his portfolio has performed. Victor's going to have a smile here in just a second. Tax savings. This is the money that Victor hasn't had to spend on his tax bill because he has these amazing write-offs in rental properties. $4,500 there and change for tax savings. Principal pay down. This is this amazing thing where your resident is paying your loan down for you. This has happened on the 2 properties over 5 years now. This happens each and every single month, and it really adds up to about $18,500 of decreased loan balance for Victor's 2 properties. And Victor, I would imagine that sounds really great, but you probably never really thought about that. You probably never really considered that. Am I thinking about that right?
Yeah, only when I refinanced, I saw that, but I don't wasn't really paid attention to it.
Yeah, it's like sneaky good, sneaky fun, right? We don't all go and check our loan balance on the mortgages that we have routinely, but man, you do this for 2 years, 5 years, 10 years, and you're like, well, that sounds awesome. And many times that amount is higher than your net rental income, which is only what people pay attention to. So got to look a little bit beyond it. Look at this, man. Home price appreciation, $175,000 over 2 properties. Clearly, there's a reason to evaluate your market based on growth potential here when we're seeing this. Congratulations, my friend. Did you know that this is the equity that you've earned?
No, not that much, because I was looking at it a little bit when I refinanced, but I know it's appreciated a lot this year.
I ran the numbers. I didn't use Zillow. I didn't use one of those aggregators. I ran my own analysis based on what things are selling for in the Jacksonville market right now. So that's a real number out there, and something you should be really, really proud of. I mean, you made the decision. If we go back to you being a crazy guy, right? You did this crazy thing that people said was crazy. Well, look at how your money is performing versus your other alternatives, mainly the traditional average ways to invest, which is stocks, bonds, mutual funds. You're crushing it, brother. And then inflation hedging here, just important to note that the consumer price index, which is what the government uses to measure inflation, is 8.3%. There is more value today to invest in hard assets and take out smart debt on those hard assets, more value today than there's been in 40 years. And the reason I say 40 years is because I'm going back to the last time inflation was measured and was this high. In inflationary time, hard assets, taking out smart debt wins. And so you are absolutely winning. I do want to point out that we do take out the selling, holding, and closing costs here when I reveal what Victor's rate of return is. So I take out almost $45,500 worth of costs because I want to give him a real picture of really how hard his money is working for him. And next slide, Vanna.
Ready? Vanna.
Victor, this is how hard your money is working for you. When you invested in those 2 properties, we gave you an expected return on investment of 12.5%. Your actual return on investment, including all 5 profit centers, is 38.1%. Congratulations, my friend.
Thanks. Yeah, that's great.
So how does this feel going through that process of doing something that people told you was crazy and coming back 5 years later and looking at this type of return, which is way more than you would have earned each and every year in the stock market or bonds or something much more common? How does that whole process land on you?
No, I mean, it feels great. I mean, I knew in the long run it was going to be good, but obviously when you see the real numbers, it's even better than what I thought.
It's amazing. And the thing that I want everybody on the show to take away is when you can earn call it 12% return or 15% return, or maybe you can earn a 38% return like Victor has earned here. Think about how much quicker that gets you to your financial goals. Think about how much quicker, Victor, that's going to get you to traveling in your retirement so you can knock out country after country after country. Like it's not just a number here. This is like affecting your life when you can have money that earns twice what it would have earned in the stock market, or 5 times or 4 times what it would have earned in the stock market here. So really thankful for the trust that you put in our team. This is the greatest thing we get to do, is report to clients on their performance. And, it's not surprising that, our clients are performing very, very well. Yeah. I won't say that's only because of appreciation the last 2 years though. I'll share a little stat with you just to kind of send us off on a happy note. I went and I looked at all of the clients that have been investing since 2006, when our clients started to place money with us, through the downturn, through the upturn, all of this good stuff. 100% of JWB clients have been earning a positive return on investment. Not one single client has lost money.
Wow, that's awesome.
Pretty cool. So there you go.
All right. I love these investor journeys. Victor, thanks so much for, being brave, man. Like, I feel like you just kind of like put a blindfold on and jumped off into like the ocean from a cliff that you had no idea how high it was, because you haven't watched the show. You decided to come grace us with your presence and let us look into this. And there's always an educational moment. For me, the biggest takeaway is this idea that you have all this equity in there, that you would be able to like pull out and put into like private investing, right? So like even right now that that mortgage, that mortgage rates, or I don't know what the rate is of like pulling out home equity, but like I would imagine that you would be able to take some of this stuff out at, I don't know, 5% and put it in 10% and just let that make money for you too, right? And just in like a 5-year time span of being able to accumulate that, to me is like the eye-opening stat of this thing. I thought that was really cool.
Yeah, you know how Victor pulled out or he refinanced one of the properties and dropped the interest rate on one. It's a more complicated decision if you have call it a 3.5% or 4% rate, and then you're going to jump up to 5.5%, because you got to think about how long, what's the payoff, you get all this capital coming back to you, it's going to work for you. So, but the one that I would really focus on, Victor, is the one that you didn't refinance, or you did refinance. Did you refinance that both of them, but you just didn't?
No, I only did one, but I refinanced the one in Kansas City, and that one, the rate dropped like 2%. So it was like 5%. I knocked it down to a 15-year at 3.5%.
And that's amazing, right? The one that I would look at here as an opportunity for you to really get to your goals quicker is to look at the Madison property, which you didn't refinance. That has a 4.75% rate, right? You could look at the value here of you being able to pull out, call it 60 grand or maybe 80 grand of equity that's sitting there, not doing anything for your goals right now. And you'd pay a higher interest rate on it. Maybe it's, I don't know, maybe it's 5.25 or 5.5 or 5.75, somewhere around there. But you could easily look at how much that is going to earn for you and justify a higher interest rate, and, put that towards whatever investment you think is best for your goals, be that another rental property, be that private lending, be that a rental property in Kansas City, if that's better for you, crypto, you name it. But you got a real asset here that could help you get there.
Yeah. Very cool. Another amazing POTW guest investor segment. I love these things. Really good stuff. A lot of love happening here in the chat for you, Victor, and for UGC for all the stuff. So really, really appreciate the community that joins us every single week, asks great questions, is a part of the conversation, joins us at Super Duper meetups, and makes friends with each other for life. If you're listening on the podcast, you're watching on YouTube, go to nyais.com, sign up, put it on your calendar, show up here one of these Tuesdays or Thursdays. This coming Tuesday, we got a super cool guy that you introduced me to, man. This guy, Michael Album. Oh, yeah. That album that's talking about remote investing, right? Like they have this like platform that's all about remote investors, right? So this idea of what Victor did, being able to be from Southern California, and that place is totally upside down as far as cash flow goes, but being able to invest in Florida and Kansas City and these different things. He's going to talk all about success in remote investing around the country. Super cool guy, surfer. I can't wait to talk to him.
I knew you were going to hit it up.
So we hope to see you on Tuesday. I'm just really, really grateful to be a part of this, and that the community joins us, and you take an hour out of your day to spend some time with us in the middle of a Thursday. That never goes unnoticed. Victor, thanks for getting to know you. GC, I'll give you kind of last words before Victor gets to chime in here as well.
Yeah, Victor, we really appreciate you, man. Thank you for jumping in, sharing your story. You don't know how much this helps other folks, the 40 or 50 folks that are here live, and the hundreds of other folks that watch in replay or in various forms, right? Seeing other people that can relate to you, you're really, really helping. And man, it's just been fun to connect. So thank you so much. I want to say a special thank you to the community. Thanks for staying long too. Geez, we're 11 minutes over here and you guys still stick it out. We appreciate you. Yeah, Victor, I'll open it up to you. Anything that you wanted to share with the community?
No, I mean, thanks a lot. It was, like I said, it was really hard to get over that initial investment, out of state. And, I heard a lot of good recommendations from you guys, and you guys have done very well for me. So, and that's why I referred other people to you guys too.
We appreciate you, my friend. Hopefully we're going to be serving you for a very, very long time.
Thank you.
Amazing. Up until next show. If you want to be like Victor, you just can't be an average investor. See you on the next show.
See you.